Welcome to my channel, everyone. Thanks for tuning into this video. Now, it's going to be another good psychology lesson on how to become a better day trader and how to know if you are trading with the proper position sizes. Now, I feel like a lot of traders fail at this because they blow up accounts, they lose tons of unnecessary money, and it all boils down to their position size. They lose too much on the losing trades and they do not win as much on the winning trades. It's all about risk. And by the end of this video, you're going to understand if you are trading with the right position size, because I'm going to share some very good tips on how you could properly enter positions and not impair your trading, not impair your emotions by trading with the right size. All I could ask is, if you learned anything from this video, if you could just drop a like, share it with other traders in any other communities you're in, drop a comment, and also subscribe to my channel. It will help me out a lot. So without further ado, let's get right into the video. So are you trading with the proper position sizing? First thing I want to mention is that the trading outcomes are outside of our control. No matter what happens in the market's always going to be smarter than us. Nothing we can do is really going to determine what actually happens to price and what the results are in the market. The only thing that we can do and control is our stress and our emotions, because us, are the only ones who create the stress, not the markets themselves. When we trade, chemicals get released in our brains, and these chemicals try to attempt to cloud our judgment. And if your judgment becomes clouded, it's going to lead to doubt in your trades, which in result will lead to losses. Now, I put this on my Instagram story the other day, basically saying the same thing about how our chemicals are released when we're trading, and that these chemicals will cloud our judgment, and these judgments will lead to doubt in our emotions, doubt in our trading plan, doubt in our strategy, and in result, any type of doubt going on in our minds about our trade is going to lead to losses, and it's going to affect our decisions, which we make based off of our ego and our emotions. Now, I'm going to link my Instagram in the description below. Like I said, I post very good tips and tricks like this on my Instagram story, along with daily trading recaps, like some of the recaps that I have on my YouTube channel. The link to my Instagram will be in the description below. Definitely worth a follow. And if you have a strategy that's proven to work, something that you have back tested, forward tested, and it's proven to show consistent results in the long run, all you have to do then is create a plan around it, a strategy with entries, exits, and also risk management is the number one important thing to any trading strategy. Once you have all that, then what you have to do is physically execute the trade, put it on. You're not going to make money if you don't put the trade on and you don't execute, and you're also not going to lose money if you do not execute. Losing is a part of the game. There is nothing else you can do once you do all of that. Anything else you try to force and do that's not organic is going to lead to emotional trading, whether it be out of fear, whether it be out of greed. You have to let the trade develop. There's nothing else you can do once you execute. And you have to make it as stress-free as possible. Trading should not be very stressful at all. As long as you have a plan, you're not going into the market guessing about where you think it's going to head. Do not let your ego get over your head. It has to be as stress-free as possible. The more stress you create, the more emotions that are going to go through your head, and the more trades you're either going to force or the more trades you're going to exit out of fear. And this is very important. Your risk should be between 1 to 5% of your total account. Now, a lot of people hop in with too heavy of a position size. Their risk is too much to their account. Let's say they have a $5,000 account. They're entering their position with $4,000 out of that $5,000, and they're risking like $2,000, $3,000 on the trade. And if they're wrong on that position, half their account is gone. They have no longevity in the game. Therefore, they blow up an account and they cannot stay and trade for a while because they eventually run out of money. So your risk should be determined based off of your position size, and this should be between 1 to 5% of your total account. Now, people with smaller accounts, it's totally fine. It's totally normal. You're going to have to put a little more risk on the table. Let's say you have a $200 account. You can't risk 1% of your total account on a trade. That means you're risking $2, and that does not give the trade enough room to breathe. You don't give it enough room to develop. So with smaller accounts, you have to risk a little bit more. Obviously, it's smaller money, so it really should not matter as much compared to a larger account. Let's say $5,000, $10,000. You shouldn't be risking $500 on a trade, $1,000 on a trade, where it's 10% or 5% of your account. It's all about risk management. It's all going to determine based off of your strategy. You know, is your strategy a high probability one? Is it a low probability one? Low risk, high risk? There's a lot of factors with trading, and not a lot of people realize that. They think it's a one size fits all. That's not the case. Your risk should be determined on each trade, and it should be determined on how far your entry is based off of where you're going to exit if you are wrong on the chart. So here we have the NASDAQ/NQ, which is the NASDAQ 100 futures, where I plot my zones off of. Also plot them on QQQ, which also had the same 4-hour supply zone as the NASDAQ future. These go hand in hand with each other. One's a future and one's an ETF. And the idea here is we come into a 4-hour supply zone, and this is a sell imbalance on a chart, and we look to take trades short inside of a supply zone as long as they're confirmation. Now, how does this tie in with proper position sizing and proper risk management? Well, here's the case. If we were taking this trade short, and let's say I want to get in with confirmation once the market's coming down, let's just say at my yellow circle, risking the high a day. And like I said, a lot of people's strategies are going to be different. Their risk, their account size, their entries, it's all going to be different per trade. Therefore, they have to react and understand their entry and their size according to the setup they are looking to trade. In this case, my stop is going to be at high a day because I'm fine with taking a lot of trades as long as my losers are very, very small. And in this case, I'm risking about 50 cents on the equity. Some people give the trade a little more room to breathe, and they will stop out above the supply zone, which is at 294. So in this case, you're risking about $1 compared to what I'm risking is about 50 cents, which is above the supply zone. If you stop out, you can always re-enter. Now, this ties into what I'm explaining here is because first you have to decide your entry. Once you understand where your entry is, you have to understand your goal as a trader is to enter as close as possible to where you're going to stop out. The closer you are to your risk, where you're going to exit if you are wrong on a chart, then the smaller your loss is going to be. So as the market is developing, as it's trading, you have to decide where you're going to enter based off of market generated information. No one's going to know where we're going to enter before it's actually trading. You have to identify the context of the market and trade and enter accordingly. So once you get where you're going to enter, let's say in this case at 293-ish on the equity, then you're going to decide where you're going to exit once you're proven wrong on a chart. I mentioned before, my exit point based off of the chart is above high a day. A lot of people struggle with this and they exit based off of a dollar amount or a percentage amount. That is the wrong thing to do. That is a big red X. You have to exit and stop out based off of where you're going to be proven wrong on a chart. Once you have those two things, then you're going to determine what your risk per share or per contract is going to be. If you're trading the equities, like I mentioned, you're 50 cents. If you are trading the option, what a tip you could do is if you could pull up the contract that you're looking to play. So right here on the left, I have the QQQ 292 puts. My crosshairs are synchronized, meaning whatever shows on the left chart is going to show on the right. You can do that by the settings right here, synchronized crosshairs. So at the time the Qs are at supply and the time I'm looking to short is the same time the option premiums on the puts are around $2.80. So if my stop loss was at high a day, then my stop on the premiums are going to be around 260. These are ballpark estimate ranges. Obviously with contracts we have Greeks, but it's going to be around the area minus a couple of cents, maybe 1, 2, or 3 cents. So I'm entering around 276, 279 on the premiums. My risk is 260 on the option contracts. So that is about 20-cent risk per contract. And for every contract we trade, that is about $20 on the option contracts. So right then and there, I know if I'm wrong on this trade, I'm going to be losing about 20 cents per contract. Then what we have to do is execute and enter the trade with the correct position size that's according to my risk. So if I have, let's say, $1,000 account and I don't want to risk more than, 1 to 2% of my trade, then maybe I'm going to only go in with one contract and risk 20 bucks on a $1,000 account or $500 account. So your position size is the last thing out of the equation. Your position size only comes after you determine your risk per contract, and the risk per contract only comes after you decide where you're going to exit on a chart once you are proven wrong. And that's only going to be determined after you decide where you're going to enter and where you think the safe entry point is on a chart, depending on your strategy. You have to trade with the right position size in which the money amount is not going to interfere with your judgments. Remember what I said about clouded judgments. In result, they lead to large losses. You have to trade with size that is comfortable and it does not impair your judgments and emotions. How many of you entered a trade and was like, oh, this is not working out right away. I'm in too heavy size. If I'm wrong, this is going to be a big loss. If that ever happened to you, you're trading with way too much size. Anything like that that's going on in your head, you have to think about how much information us traders process on a daily basis. Anything that interferes with our thought process, our emotions, our judgments, it's going to make us uncomfortable. The whole goal and objective here is to trade with size that is comfortable for us and does not impair anything that's going on in our heads that is going to influence our trading decisions. If you find losses upset you and they stress you out, the simple solution is to reduce your position size, whether it be by half size, a quarter size, 3/4 size. You have to get it to a happy medium where you enter trades and you are not going to be upset or stressed out no matter what the outcome is, win or lose. The only way to do this really is experiment where, you're not uncomfortable entering a trade, where you're not, shaking in your chair, where you're not sweating when a trade is put on. These are all real emotions that a lot of people have. Therefore, it gets in their heads mentally and they blow up accounts and they take unnecessary losses. It really hurts me. It sucks seeing other people take losses. That's why I'm making videos like this, so you all can understand my outlook and my psychological thought process with the whole market. So you simply cannot stay objective when you feel uncomfortable. This is with anything in life. Trading is so similar to real life situations, and this goes with anything. You cannot be objective when you are uncomfortable. Think of any other uncomfortable situations you've ever been in, trading related or not. Your decisions are going to be based off of your feelings, for you to get rid of your pain, for you to get rid of whatever uncomfortable emotions you're feeling. If any decisions in trading are based off of your feelings, they are wrong decisions. They should be based off of the strategy and based off of the plan that you have been executing. And then the last thing I want to leave you all with is smaller position size equals a wider stop loss. A lot of people go in with too heavy size and they cannot afford the stock to give it room to breathe and develop. Smaller position sizes equal wider stop losses. You have to give the trade more room to breathe. Therefore, go with smaller position sizes. The whole goal with trading is capital preservation. Your goal is to live on to another day and making money in the process. You can hit home runs in trading. It happens, and we all strive for home runs. But if you keep swinging, eventually you're going to strike out. Smaller position sizes with consistency will lead to larger wins. Larger position sizes with tighter stop losses is going to lead to a lot more losing trades, and you could hit home runs with larger position sizes, but we have to be very defensive as traders. Larger position sizes usually tend to come with scalping strategies, and you do not give the trade a lot of room to develop because we're in with larger size and we cannot afford a lot of losers, because a lot of losers will lead to a lot larger dollar amount losers. Therefore, we have to go with a tighter stop loss. So I hope you all enjoyed this video. I'm going to continue to make these type of psychological videos, things that not a lot of people really discuss and go over. These things are very important, and I want to see a lot of people not blow up accounts anymore. I want to see them stay in this game. I want to see them all have longevity, because that's what trading all about. It's about the process, really not so much about the money. Obviously, that's the end goal, but it's more about the process, enjoying it, and learning on the way. So if you all learned something from it, please drop a like. Please subscribe to my channel. It will help me out a lot. And I hope to see you all at the next video.